Palantir stock has been trending in popularity recently, and many people are wondering if they should buy more, sell what they have, or stand on the side and wait for a better timing. As the market is still very volatile at the moment, we should be mindful about which stocks to pick and what should be the exposure and their timings. Over the past few days, the price action of Palantir has brought the stock to around $12.12 before stabilizing to the current $10.82 level. Palantir is a stock to which many investors have a complicated and delicate relationship with. It's one of those stocks that the market put an immense amount of hope in, and it's also one of those stocks that has left a lot of people overly exposed to the tech and the speculative side of tech sector. The current market is on a quest to explore the possibility that the sell-off may be ending, although there's nothing that guarantees it. The market has been quite tough on Palantir and many other similar stocks recently, as it fell almost back to the level when it first went public. To me and many others in the market, this is a possible sign that the sell-off on Palantir has lasted long enough, and there is a real possibility that the market bottomed. Either way, it's either that, or we're looking for a much lower bottom for Palantir, by which point the company may have to change its key management or the key strategies. To conclude, as far as opportunities to buy Palantir is concerned, I think that there are few moments like this one, and I believe that when opportunities present themselves like that, we should definitely seize them and be willing to take a reasonable level of risk when needed. What this means is that we still have to make sure that our exposure doesn't bring the entire portfolio down with us, but if things go the wrong direction, which they still might, this is really in the inherent nature of trading, and we should be prepared that our positions may have different outcome that we initially hoped, and then we make decisions based on probability. At this moment, I think that probabilities are in our favor. Now, with that being said, let's take a deep dive at the technicals. The trading volume of Palantir has recently been 10 million shares, compared to an average volume of 31 million shares. Over the previous 52-week period, its price fluctuated between $9.74 and $29.29. The market cap of Palantir is currently at $22 billion, compared to an enterprise value of $34 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or a negative image amongst market participants, the assets value might be impaired. With that being said, at the end of the day, it remains an estimation to the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient as well. One key element to note about the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation or an assumption of the market that the company can generate more profit or grow faster, because it may have a better management, a stronger brand recognition, and a bigger online following. It is basically what makes this company unique compared to its competitors. In other words, it's not a tangible asset that companies may use. It is, however, often the reason why some companies are perceived to be trading at a discount, because the market is lower than the enterprise value, and because the enterprise value may be less reactive than the market cap in volatile situations. If the company goes to liquidation, the goodwill would be gone, and we would be left with potentially less assets to distribute to shareholders and debt holders than the number on the balance sheet. When we compare the current price to the historical price fluctuations, the stock is 5% higher than a 1-month low, 11% higher than the 12-week low, and 11% higher than the 52-week low. On the options market, which often gives us a hint about the market sentiment on where the stock price is likely going to go next, the implied volatility is 81%, compared to a historical volatility of 64%. The put-call volume ratio is currently 0.7, It's normal for many stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 9.7 thousand contracts within a day, compared to the 30-day average volume of 81,000. In terms of open interest, the most recent volume of open interest has been 3.4 million contracts versus the 30-day average of 3.3 million contracts. In terms of shareholder structure, institutional shareholders own 33% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and State Street. It's relevant to understand the shareholder composition of a company as this helps us to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. The consensus is that usually there should be around 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions since there are many great companies, mostly held by retail investors as well. But so far that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. When there are significant short interest in the total volume, this can be a sign that there is an organized shorting operation going on, like what did happen with GameStop and AMC. The current short interest is 7% of the total float and 45% of the transactions coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short volume coming out of the dark pools, or at least outside of public exchanges, this may suggest that there are institutional positions taken to short the stock, and there would be potentials for a short squeeze. I would therefore recommend to buy a significant portion of your allocated amount in Palantir now and to hold it for at least 6 months or longer. I would recommend to commit between 3 to 5% of your portfolio. I would also recommend to split the allocation in batches of 20% or more at a time so that you can have some room for later purchases as well. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.